Welcome to our podcast, Michelle and Stacey, all things small business.
We hope you enjoy this episode and please visit our website, michelleandstacey.com.au.
That's MICHELLEANDSTACEY.com.au. We would love to hear from you.
Hello and welcome to episode 11 with Michelle and Stacey talking all things small business. Now today we're going to be talking about selling your business, when you're selling your business, and the due diligence component of that needs to happen.
Yeah. So I think what are the things we're going to cover? We're going to cover what is due diligence.
Yes.
Why it matters, and really then I guess at the end of the day, how are you going to sail through it to help you sell the business, right? Because you don't want to get stuck in the due diligence process.
Absolutely. Okay, so I guess let's kick it off. What is it?
Well, it really is. It's about giving information, right? So it's, information is key and planning for information is key. Again, it's like proof. Like information is proof, because you would have been talking to these people for how long? It could have been a couple of months, it could be quite a long time. And you've talked about your business and you've said, we do this, we do that. But realistically, at this point in time, you wouldn't have given them anything. So you are saying, okay, here's what I've been talking about. Here's all the proof. Here you go. Yeah?
That's right. And so you've built trust with this potential purchaser through all these conversations you've had, as you've said, Michelle, over the last couple of months. But you're at a point now where they really want to make sure that, you're not all talk with nothing behind it to substantiate it. So this is, due diligence is, about giving them some information so that they can
giving them clarity.
Clarity,
Yeah, on the information that you've been giving them.
So I guess now we sort of understand what due diligence is and, about giving this information so they can seek some clarity. I guess is there something we need to do before we give them that information?
Well, we've already spoken about it, but if you haven't already done it, you definitely need to make sure before you hand over any detailed information. You really should do it before you start the process and give them any information. But you need to make sure that you've got some kind of written down confidentiality agreement, or, I don't know, what's another thing?
An NDA, which is a non-disclosure agreement.
Yeah.
They can be called all sort of different things.
Yeah, and they're all different. Yeah, but you want to make sure that you've got that to safeguard. And pretty much what that is saying is you're getting them to sign saying, I'm giving you this information. This information is not to be used for anything else apart from you to assess the sale of this business, and you're not to disclose it to anyone else unless we've given requests. So they can't take it home and give it to all their mates and show, oh, hey, look at this business. It's only for them, and it's only for the purpose of them to assess the value of the business. They're not allowed to use it for anything else.
That's right. And depending on the scale of your business and how sensitive that information may be in the broader market, you may not even be giving them documents that they can have copies of and take home and, read at their leisure. It may be in some of these bigger deals, which, is not normally the mum and dad size businesses, but some of these bigger companies and businesses that sell, is they have windows of time where they can go in without devices into, like locked rooms.
A data room,
and look at the information in there. And they're not allowed to take phones or laptops or anything in, so they can't be taking photos or copies of any of that information. It's just for them to view during that window of time in the room and ask any questions.
Yeah, and they may, it might not necessarily be just them, but I guess you as the seller would agree who's going to go in. So they might have their lawyers, their accountants, various people experts that might know the business or the industry. They might want them to come and look at certain documentation and themselves. But it's going to be fairly limited.
Yes.
But you need to approve who's going to look at the data.
Yes. Yeah. So as I said, that's probably less common because it's probably...
Because of the size. Like,
yeah.
I mean, I've done some sales with, you know, much larger businesses like large corporates and stuff, and you definitely have all that, and the data room is prepared, and it might go for, you know, 4 to 6 weeks. But when we're talking smaller businesses, it's not very common that you would do that, like go to such lengths because of the size of the business. And, you know, generally speaking, it's probably not going to be as complex.
Yeah. Yeah, and to go to that length, you know, there's cost involved in that. Massive cost. So, yeah, so it comes down to, you know, the size of the business of what you're selling. So, more common than not is that, you have some kind of agreement that's written up on paper, that's signed by both parties, you being the current owner of the business and the potential purchaser, and anybody else that is wanting access to those documents to advise or to assist in that process. It could be the lawyer, it could be the accountant, it could, you know, a whole heap of people. Everyone should be signing a version of that document so that they're all bound by the same rules.
Yeah. So what kind of information would you... I mean, there's lots of information. So I think now probably the best time we'll go through the type of information, the type of documents that you're going to supply as the seller.
Yes.
And again, this is something that you don't want to do, go, oh, I've got to this stage, now I'm going to do due diligence and I'm going to start putting it together. As soon as you're thinking of selling or any kind of thing, you really should be talking to someone, if you don't already know, how to put this together, because sometimes it can take quite a long time and you may not have the documents that you really do need. Let's talk about, well, the one you probably will have for sure is your financial statements and your tax returns, right? Because no one's going to buy your business if they don't see the financials and you haven't been lodging your tax returns. So that's pretty easy. So generally, I don't know, I always kind of give 3 years, sometimes 5. And again, it depends. And it depends on what's been happening.
That's true too. And it also depends, I guess, how big this sale is and how far down the track you are with it. Because some of what you may end up doing is only giving 1 or 2 years at the start so that they can see, and then it may grow into, actually, I want to see 5 years because they've asked a whole heap of detailed questions, and, you know, they need to see a bit more data to be able to understand what you're saying and to support what you've been saying. So it sort of gets a little bit led by the potential purchaser. Yeah,
and then I always do, because normally it's you know, because it is small, I always do like a normalised one. I don't just give them, oh, here's the financials that we've prepared. I'll do
What's
a version.
Normalised one?
Well, it's really adding back, like it's really like an EBITDA in a way, plus anything else that the owner may be using. So, for example, if they've got a motor vehicle, if they have their own property, their own commercial property that they rent out to themselves for the business, I'll add back stuff like that. Anything, I guess, that's been paid for by the owner. So, you know, you'd add back their salaries. You'd add back, you know, obviously salaries, super, depreciation. You know, if they've bought a lot of assets and stuff, I'd add back interest on any kind of loans. And that kind of takes it back to the bare basics, saying, forget about, you know, the person running it, you know, because you could have a profitability where it's like nothing, at the end of the day, when you've put all those costs in. But you pare it all the way back, and it might be $200,000, $300,000, $400,000 profit, right? So that's before the owner's taken out what they want.
Yeah. Exactly. So I guess the context behind that, just diving into that a bit more. So you're pulling out, say, the interest component on some loans and things, because the reason you're taking those out is that the potential purchaser most likely won't have those loans. They'll have a different form of loan or finance, or they might not have finance at all. They may have a lot of cash.
If it's a larger business buying a small one to be a bolt-on add-on, they might just be buying it with cash and not need that, and they might need to rent a property, so they're just going to integrate it into their existing business and things like that.
Correct. And the current owner may be paying themselves a ridiculous salary that's not even market.
Might not be market, that's right.
So,
or they might be paying themselves too low.
Correct.
But then, then they're overstating the profit. But
So that's the reason for why those normalisation adjustments would be done.
Yeah, and then you do you put the tax returns in as well to show. I do anyway, to show that just because I've given you a set of financials doesn't mean that's real. To me, it's real. If you've lodged it with the ATO and you've paid tax on that, and that's pretty much should be, unless you're diddling the tax office. That is real, yeah. The other thing I would do as well is if there've been tax adjustments between the financials and the tax return, I'll do a little, okay, this was the tax return, these were the tax adjustments to agree back, so you can see, yeah. So you're very transparent, very upfront, so that gives the person who's buying it clarity, and that gives them a sense of, well, I can trust this.
Yeah, it gives them some confidence in what's going on. So your words are matching up with the actions and the documents.
Yeah.
So it gives them some confidence and builds that trust even further.
Yeah, that's right. That's right.
So some other documents that we may get asked for that may need to be provided would be some other agreements and contracts. So these could be supplier agreements and contracts, for example. And why would maybe they ask for those? What would they be looking for in those?
Well, and again, it depends on the type of business it is and stuff like that. But you might be getting, you might have a supplier contract, and you've got a very good. I did a deal a year or two ago where someone was buying goods from Europe. And they basically, it's really hard to have when I say you can have a contract with someone who supplies you from overseas, but it's not really worth the paper it's written on, because as if you're going to go and sue someone in a different country, ain't going to happen, and particularly if it's a small business, right? But if you've got the supplier agreement, that's good, but what you'd probably end up doing is not only have that, you'd show, okay, this is the agreement I've got with them, but through the process, you would do introductions. You would tell the supplier, I'm thinking of selling the business. This is the one. If it's integral to you making the money of the business, so you've got you might have somewhere where you just buy that product in Australia and no one else can buy it. And so you want to be able to introduce them to the supplier so they get to know them, they know what you've been doing, and you're comfortable that that's going to continue, particularly if you're buying particular products that no one else can buy.
So it's basically a bit of a transfer of relationship.
Yeah.
But you can't transfer a relationship that you don't know about.
No.
Or make an inquiry about getting an introduction to those people if you don't know about it. So that's a big reason why a potential purchaser would ask for that. As another one would be, which is one that's quite interesting because it's sometimes forgotten, is employee contracts.
Yes, and I was just telling Stacey before we started, I'm talking to one of my clients who's grown his business quite substantially in a short period of time, and he's gone from pretty much nothing to probably 15 different employees. He doesn't at this point have employee contracts, right? Now, he's not going to sell the business, but when you're growing to that size, you really should have employee contracts, because you're opening yourself up to issues, and it just safeguards you in the business as well. So, I mean, if someone wants to buy your business and there's no employee contracts, they don't really know what they're buying, if they're going to take the employees with them, if they need to, right? So they really want to understand that. So if you don't have employee contracts and you're thinking of selling, go and get them.
And look, I guess best practice is to have employee contracts regardless of whether you're thinking about selling. But look, a lot of businesses don't. Yeah, businesses sometimes grow so fast, and they employ a friend of a friend, or a family member or something.
That's right.
And it just doesn't get done for whatever reason. Like you're small business owners, like, you know.
Yeah, there's only one of you and there's only so much time
I'm sure
in the day.
many of you out there listening can relate to this. And there's probably things that aren't even employee contracts that are other things that are on your to-do list that you haven't got to yet either.
Yeah.
So, you know, you're not alone there. You know, we're talking about best practice.
Yeah.
You know, so...
but in talking, and again, about employees, I mean, obviously you now with, you know, STP and having to do your payroll through the ATO, that's all going to be documented. In the past, it may not have been documented, but that's pretty easy to prove. And also it shows, you know, what you're paying them and the super. That's different to a contract, but, you know, that's clear. But what's not clear on your STP is if you've had employees for a long time and they may be entitled to, say, long service leave. And traditionally, a lot of small businesses don't record the long service leave owing on their balance sheet. So you'll need to do the calculations before you get to this stage and make sure, and it's quite complicated, like you want to make sure that you've got someone who knows how to put it together, the actual long service leave components.
Definitely, and your accountant should be able to assist you with that. So yeah, if that's not something you currently have on your balance sheet and you have got staff that have been with you for quite a while, that's something I would be talking to your accountant about.
Yeah,
that's a really good one. What else?
Well, if you're renting a property, and it might be, you know, you've got your business in a certain area and it's, say for example, if it's a restaurant and you've been in there for the same period and you've been there for like 15 years and you rent the property for that, and obviously people are coming to that restaurant, they don't want to, you know, you're not going to shut it all down and fit it all out, you know, 3 miles away. It's really, you need to have that there.
Location. Yeah.
So you want to have a look at the lease, or the purchaser will want to have a look at the lease agreement to say, okay, well, I've got no lease agreement, so therefore what's the certainty that it's going to continue? Or if they have got, they might have a 10-year or something, what's the terms, what's in it, how much is the rent going to go up? What are the conditions and things like that.
And how much is left on that lease agreement?
Yeah.
Because if there's only a year left on the lease agreement, then, you know, what's the certainty for that new purchaser that they're going to be able to retain that location, especially if that location is key to that business being successful moving forward.
Yeah.
So, yeah.
Other things are like if you, like customer information, right? So one, you know, detailing all your customers. 2, you might want to show what you've sold to each customer over the last year or so, you know, where you're getting your real money from and what types of products or services that they're buying. So
maybe even the locations of those customers, like their geographical location. So are they all local? Are they overseas? Are they, you know, in all different states, you know, around Australia? Or are they, because that might play into...
I guess it depends on how you service them, like whether it's products that you've got to send or you're servicing or whatever. But that'll all come out. Yeah,
that'll all come out too as well. Another one, I guess, is equipment list. So, like asset registers. This is one that a lot of small businesses sometimes don't have.
No.
Why that's important is that a potential purchaser would be really interested in what equipment is there, so that at some stage they're going to want to eyeball that equipment to make sure that equipment actually matches up with what you're saying you've got that you would potentially sell to them. Also, how old is that equipment? And how is that equipment serviced? And are there agreements in place that it needs to be serviced by certain people to retain warranties and things like that? How much does it cost to get that equipment serviced? How frequently does it get serviced? Or does it get serviced by and repaired and maintained by key staff members, for example?
Or it could be just could be just all your laptops and PCs and all that kind of stuff. And it might be you go, I'll just give it all to you, but it might be kind of worthless if it's, everything's about 5 or 6 years old. You'd probably have to go and replace it, and depending on how many people you've got. So what's the real value of that in the sale to you? Okay, it's a bit of value, get you started, but it's going to kind of help you as well. The other thing, I guess, and that's going to help you work out the value. So say you've agreed with someone, I'm going to sell my business to you for $500,000, I'm going to throw in all this equipment, right? So, okay, well, what's the equipment worth to me? So you'd kind of look at stuff, and again, this is for the purchaser trying to assess the value, but you need to understand, I'm going back into the value, but
okay,
you need
they're all linked and related.
Yeah, it's all linked, but you, again, I've just recently putting stuff together for the equipment. Now, really, the equipment that this person was selling as part of the sale might have been worth nothing, $10,000 or something, but he's had it for a while. It's still usable and it's still fine to use, but so we've put that down. So for me as a seller, I want to make sure that I'm really only valuing that at $10,000, whereas if they have to go out and buy all new stuff, it might cost them $100,000 to go and do it. So really the value to the potential purchaser might be a lot more than $10,000. And again, it depends on how you're going to structure that cost in terms of the difference between goodwill and equipment, because we all know that, well, hopefully through our past episodes, you've kind of started to work out, what's tax-free and what's not. Goodwill, if you're a small business and you qualify for the small business concessions, then the goodwill is tax-free. The equipment this is for the purchaser. Well, the goodwill is tax-free for the seller, but the equipment sales they'll have to pay tax on that regardless. Yeah. Whereas on the buyer way, they want more on the equipment and less on the goodwill, because they can write off the equipment straight away, whereas the goodwill will just sit on their balance sheet until they sell it, so they don't get any tax benefits till they sell the business, if they ever sell it.
Yes. Yeah. No, very good. Another one is intellectual property. So intellectual property is a bit of a tricky one. So I think we have spoken about intellectual property or IP before. So just to recap, I guess what that is first, it's things that are intangible, so things you can't physically see, but are very valuable and key to the business. So it may be things like trademarks, it may be things like formulas that are used to make products.
Or a brand name.
So that's what intellectual property is. And so why is it important to know about that or be aware of it? Well, if you're using a particular name or you've got a particular formula that you use to create your product, is that documented? Is it protected? Is it something that you can give some document? You've got a document that you can show this potential purchaser what it is, so that they do have that documented. Okay, so if someone got hit by a bus, we've got this and this, we can keep producing this and it can keep going.
But even like a business name, right? So either, you own the business name, you can have the business name registered, or you don't have to have the business name if the company has the name of your business, right? So you can transfer that over to the new business. But if you don't have either if you're selling a business and it's called Mr. Microphone, right? But you haven't registered that business name, Mr. Microphone, or your company is not Mr. Microphone Proprietary Limited, there's nothing you can give over, but the business might be reliant on it being Mr. Microphone. So you're at risk, being the purchaser, that someone else can come in and use Mr. Microphone and there's nothing you can do.
Yes, absolutely. And we'll probably talk about this a little bit later, but just to touch on it now, is the structure of the deal may be that you're buying the entity, or the structure of the deal may be that you're buying the business assets. And so if you're buying the entity, then in Michelle's scenario there, you're buying Mr. Microphone Proprietary Limited. That's okay, because
But provided that's your business name, yeah.
Correct, yes, and you'll continue on. But if you're buying the assets within that business and not buying the entity, that business name may or may not be available
Oh, no, but if you've got it under Mr. Microphone Proprietary, it doesn't matter. Then they just set up a new company and transfer Mr. Microphone name to the new company.
But if they haven't got the name,
Mr. Microphone,
then there's a problem, right?
Yeah.
So this is part of the due diligence process.
Yeah.
This is why it's important that that the potential purchaser gets to see these documents. It gives them, as we said at the start, confidence and clarity, and builds trust, and makes this deal go through the process a lot quicker. If you've got all these documents, and as I ask them, you're like, oh yeah, no worries, I'll pull it out of my drawer, here it is, and you can do that. It makes the deal go quicker because they're building trust and they're able to tick their the boxes on their checklist off quickly. But if you're I'll come back to you on that, then you're actually off registering the name and you're doing this, and that can take up to 28 days in some cases. And then that's delaying, and then you're giving them some fudge story for why you can't find it, blah blah blah. Then you come out 6 weeks later with it. Well, they might have cold feet by now.
Yeah, that's right. Time is of the essence, isn't it?
It is. Yeah. It is. So I guess what are some other documents?
Well, if you're a manufacturing company, you might have, I think you touched on it before, but product specs. If you're manufacturing something specifically, you want to make sure you've got all the specifications and how they manufacture it and what's all the process of manufacturing. You might have a list of stock that's going to go, well, generally at the due diligence you wouldn't have the stock, but you might say, generally speaking, my stock levels are $100,000, so therefore my sale's going to be, $500,000 plus whatever stock it is left, right, on top of it. So that kind of information. You could also have, if you were a service industry like what we've got, like tax practice and advice, you might be, people might want to buy it because you're really efficient at what you do and how you do it. And so if you're really like that, you've got really good processes in place. So that obviously would be all documented. So you would want that detailed documentation to take to, you might be being bought by someone who wants to implement that in their business. So that's important.
Well, I think that's a pretty good.
Yeah, I mean, it's not exhaustive, but I mean, it gives you an idea of all the things that you need to make sure that you're pretty much on top of before you get to this stage.
Yes, you want to have at least those documents ready to hand over if you were requested for them.
And I guess the other thing we haven't really talked about is the timing of it.
Yes.
So, and again, it depends on how the business sale is going. Much larger business, it's a much stricter process and more timing. But if it's a smaller business, you might give certain bits at certain times. As Stacey said, first of all, you might just have a chat and you might just give them last year's tax return, or last year's financials. And you're doing that to test how much, how real the purchaser is, because you don't want to waste your time. This is really time consuming, yeah? So if you give it to them and then you don't hear from them, they're not excited, you go, yeah, okay, well that's easy. It took me 5 minutes, I'm not going to bother anymore. To pull all this documentation together is a lot, to make sure it's all up to scratch.
Yeah.
So by the time you get to the detailed due diligence and documentation, you want to make sure that they're pretty close to signing on that dotted line, yeah?
Absolutely. Yeah. Absolutely. No, I think you've summed up that timing piece really well.
Yeah. And if they are kind of chomping at the bit, ready to go, you want to make sure that you've got it all set up, you can give it to them, because the longer, as Stacey was saying, about trying to register a name and it's not there, they'll go, and then they'll start looking or thinking, and they may go off you. You may not want to buy it. So timing is critical.
Yeah. Very, very. And so I guess we've talked about a whole heap of the information and the timing. Who gives this information? Who's best to give all this information?
Well, again, it depends on what it is, but the majority probably will be a combination of mainly your accountant and yourself within the business, pulling it all together.
Yes.
And again, it depends on, Stacey also touched on this, whether it's a sale of just the business and the business assets or the sale of the total entity. So you're selling the company. So if you're selling the company, the lawyers may get more involved, because if it's a share sale of the entity, then the reason the lawyers need to be involved, and you might not necessarily provide all this information, but as the purchaser, their lawyers are going to go and look. So, for example, you might have been sued by an employee 3 years ago. You've made a settlement and it's all done. You think it's done. So what their lawyers are going to go and do is go, is there any chance that person could appeal? And what's the timing on that? Because that's risk. So when it's a share sale, the person purchasing those shares buys all that risk with the business.
They're liable for the history. So it's what skeletons are in the closet on that business,
exactly.
in that company, on that entity. And that's basically part of the due diligence process and the job of their advisors, so their lawyers, their accountants, to really open that can of worms and find out, because that's going to lower the price, right? Remember, they're going to want to get your business for the lowest price possible. You're going to want to try and get the highest price possible. So they're going to be looking for any avenue that they can to negotiate on price. So, and they also want to know what they're getting themselves into if they're buying the shares.
And I think also, even though you might not give them all the details, but I think you need to disclose that has happened, right? Because we'll go on to the next thing, which is, I guess, the risks of not doing a proper due diligence from your end. Say, for example, you did have that and you thought, oh, it's all done, I don't need to disclose that. But you haven't checked that there was an avenue for someone to come back and reopen that. You could get sued if you haven't disclosed that through the due diligence.
That's right.
And you don't want to go, 2 years down the track, you've sold it, you're sitting in the sun somewhere, and then you get a little document from the lawyers saying, hey, you're getting sued because you didn't disclose all that information to me.
Yeah, exactly. And that's like the litigation risk, right? And it's not just, well after the fact and you're out of the business. You could be still working there in the transition phase.
Yeah, true.
As well. So, you've really got to be very mindful of yes, of course you want this deal to go through, and you want to get the best price possible, but you also want to be able to sleep at night too.
Yeah.
So it's in everyone's interest to make sure that you're disclosing everything and covering all bases off.
Yeah, and the main, I guess one of the things which we've said, but one of the big risks is if you haven't got the due diligence right by the time they're ready to sign on the dotted line, you have a very high risk of the sale falling over. Okay, because by that stage, they're ready, and if you're not ready, they'll start to have doubts.
Yeah. Yeah, definitely. Well, is there anything else?
I think we've kind of covered everything, really. I think, there's probably 3 key takeouts for me when I'm looking at due diligence. Number 1 is planning. Planning is key.
Yes.
Right? So planning about all what we talked about. The number 2 is the timing. Slow means, so slow and steady doesn't always win the race in this scenario, right? You want to make sure that everything is done and it's there for them, so you don't risk the sale falling over.
Yes.
And then probably the last thing is you don't want the post-sales hassles. You want to minimise that litigation risk. Yeah.
Absolutely. Well, thank you all for joining us today and listening to this episode. We hope you've enjoyed it as much as we have putting it together. Our next episode, if hopefully you're keen to join us for that too.
Hopefully they will, Stace. They will.
Good. And so what episode is that?
That's episode 12.
12. Wow.
So we're nearly at the end of our 13 episodes on selling your business. So the next one, number 12, is going to be talking in more detail about all the risks. We just want to go through the risks of selling your business, and we'll go through in detail. Like we've covered them in probably the last 12 or 11 episodes, but we'll go through in a little bit more detail.
Yes, absolutely. Thank you all for listening.
Thanks. Bye.
Bye.
Thank you for listening to today's episode. We hope you found it informative and useful. We would like to clarify that this podcast is for educational purposes only. The conversations are of a general nature and do not qualify or constitute as financial or tax advice. The views and opinions expressed by the hosts and guests are their own and do not reflect any official stance. We make no guarantees about the accuracy, reliability, or completeness of the information presented and are not liable for any losses or damages arising from its use. We recommend you seek the advice of your own legal, financial, or other licensed professional before making any decisions based on the information provided in this podcast. We hope you enjoyed today's episode and tune in again soon to listen to further episodes.